So Q2 market summary. So if we go to the next slide, you've all seen this curve a few times if you've joined us before. The green line is the Vermeulens construction cost index. The dots are bids received in the markets. And this black line is the compounded trend line, and that's trending at 3.5%. What you can see looking at the beginning of the pandemic in April 2020 through to the end of Q2, things have been flat. The COVID impact was a flattening in costs. As the contractors are starting to fill their backlogs and workflow, Q2 again was steady. However, busy markets, or certain markets, particularly here in San Antonio, Austin, where I'm located, we're seeing these spikes due to limited workforce and obviously some of the material escalation that's happening. The escalation portion of things is kind of on this bottom chart here, where you'll see the red line, which is PCE, which is personal consumption expenditures, and how they trend. And they've been trending below the long-term average targets of 2%. And you can see that current jump. So this inflation we're seeing, that current jump in the red line is roughly about 4%. So in this next slide here, the green line is quantitative easing. It's essentially the purchasing of bonds, and the orange line is interest rates. So these are two tools that the Federal Reserve uses to impact inflation. So inflation and employment are the targets that propel monetary policy and subsequently construction prices. So as we mentioned in the previous slide, this new normal of pushing inflation above 2% and high labor force participation will mean 0 to 0.25% interest rates and continued asset purchasing for the next 3 to 5 years. So continuing low interest rates is good stability for the sensitive construction sector. Some of the metrics we track on the next slide have shown a decrease. Non-residential demand, we'll look at that here briefly, has decreased. Real interest rates are decreasing. And then construction employment, we actually had a slight pullback in Q2. So looking at the construction volume in the country, there has been growth. Q2 saw 2.6% growth over March, which is a 12.12% year-over-year increase. However, this was driven mostly by the residential input. You can see the middle bar there. Residential construction is up 37.3%, which is having some impacts on labor and materials, as we all know. However, non-residential volume, which is the sector that most of us are working in, is down 4.6% year over year. And infrastructure spending is also down 5.4%. Construction employment here, with the orange line being unemployment rate and the purple being the actual labor, you can see there was a decline in labor in this last quarter. Construction job growth was down 38,000 jobs. This could be perhaps due to the resurgence of the pandemic. And then the unemployment rate is currently sitting at 7.5%. This is down from 8.6%, but this is indicating a contraction in the labor force. Looking over the rest of the country, this is kind of our temperature map that shows the rate of change June 2021 over June 20. So the blue markets are actually contracting, so that's where there's less construction labor currently than there was a year ago. Green is below average, so kind of below our long-term trend line, and yellow is average. So the construction prices for non-residential sector were flat in Q2 2021, and this is a national. As backlogs begin to rebuild, sellers will restore their margins and cover supply chain risks. Assuming an economy that continues to reopen, we're recommending 0.5% escalation going forward through the second half of 2021. Local markets with excess demand may require additional bidding contingency and scope alternates. So in addition to the 0.5%, we're recommending a 5% bidding contingency in those busy markets, and also a range of 10% in scope alternates. So this will allow for flexibility given the volatility. And again, the Federal Reserve's new normal will raise inflation indexes above the 1.7% trend line. Short-term inflation is targeted to exceed 2.5% for the next 3 to 5 years to reestablish that 2% long-term target. Shifting gears a little bit, just to give you some perspective on one of the institutions that we're working with here. They're seeing increases in their cost, but they're seeing volatility across bidders. They're getting some feedback saying we can't. So there's just not, on metal joists, for example, they're basically saying, sorry, we can't provide them, and price isn't even really not an impact, is just not available. For Texas A&M, the labor issue is actually working itself out. They pull a lot from Houston, and the Houston market is down in productivity and construction volume. So even though they've seen increases, they have been able to bring all their bids back to GMP values. So they've been able to negotiate with the team to keep projects on budget. What they do is they look at the major trades, right? So electrical has been a big problem across the board, looking for maybe some sole sourcing issues. Another area to look at is reviewing in detail WRPs, or work remaining to procure. A lot of times this could be owner scope that's outstanding, or something that may be able to draw from the contingency, so working on that contingency. Big picture, they feel the market is manageable, work with the subs, work with the problem, not the people, and focus on the trades that have the issues, and then a lot of problems can be solved if you really dig into the details.